Hello and welcome to Trading 5 Talents. In today's video, I want to cover the buy right strategy. Now, I've been discussing or at least mentioning this strategy in several of the previous videos, but I wanted to officially make a video just to explain for those who don't know what this strategy actually is. So before we get into defining what this strategy is, let's give an overview of the wheel strategy because it is closely related. So the way that I trade the wheel strategy is I first have some cash on hand and sell a cash secured put, which gives me the obligation to purchase 100 shares of that particular stock if the stock price falls below the strike price of my put. So if it doesn't, I get to keep my money and I get to keep the premium and then do it again. Now, if the stock price falls below the put strike price, then I'm going to be assigned and I have to purchase 100 shares of that particular stock. Now that I own the stock, I'm going to use it as collateral to write a covered call or sell a covered call against those stocks that I own. That would be the second part of the wheel. Now, that covered call, if it expires in the money, I'm obligated to sell those 100 shares at that strike price. But if it expires worthless, then I can repeat that process and then sell another covered call again. So let's say the stock price goes above my call strike price. I'm now assigned. I sell those shares and I get all my cash back. And then I've completed the wheel and I can start over again with a cash secured put, either on that same stock or on another stock that I own. So that's the overview of the wheel. I have several videos about this particular strategy on my channel. So I'll link to the playlist if you want more information about that. Now with the buy right strategy, this is pretty much the second half of the wheel, or at least the bottom half of the wheel, at least the way that I showed it in the previous slide. So this is really just writing or selling covered calls. So first you start with buying the stock or buying 100 shares of the stock, and then you sell a covered call or you write a call against that stock that you own. Now, if the call expires worthless, that is, the stock price never closed above your call strike price, then you can simply write another covered call against that stock that you own. But if the stock price closes above the call strike price on expiration, then you are assigned that call. Therefore, you have to sell all of your shares, or at least 100 shares per contract of that stock. Now that you have your money back in cash, then you can just repeat that process if you want and buy more stock, write another covered call. So this is why it's called the buy right strategy. Buy stock, write a covered call. Or you can see it's the bottom half of the wheel. So 3 simple steps in initiating this strategy. First of all, you need to find a stock, and it has to be a stock that you're comfortable holding for a while, just as all stocks are when you sell options against them, because you could be holding them for a while. So I use a screener to find my stocks when I either run the wheel or I'm looking for a buy right strategy candidate. And I use optionsellerroi.com or I use weeklyoptionslist.com. And I've done extensive reviews on both of these websites. So there are links on my channel or videos on my channel, and you can find out more information about both of these services. For this particular strategy, I do like to use optionsellerroi because it updates every 20 minutes or so. So you can run the screen at any time. And if you're in the middle of a week, then you can go ahead and run that screen, set your days until expiration, and you can find a good candidate for the buy right strategy. I've also used barchart.com as well as finviz.com. They have some free screeners on there that you can also set your criteria and find a good candidate for this particular option selling strategy. I also like to run this strategy on stocks that I've traded previously, that is, because I'm a little bit more familiar with their price action. It sort of helps to know what that previous historical price action has been. So that's why I like to do this on stocks that I've traded previously. Then, of course, I just add those stocks to a watch list and I can monitor them over the week. And when I'm ready to enter a trade, then they're all just right there in one place. Second step is knowing when to open this strategy. If you do this on a strategy on a red day, or let's say a red move, there's a downtrend with a particular stock, there's a higher chance of that stock increasing. Now, of course, you could also be, sort of guilty of trying to catch that falling knife and it just keeps on going down, especially in a market situation or market environment like we're in now. But as those stocks get lower and lower, well below what they're normally trading at, there's, of course, a higher chance of that stock increasing. It's not like you're trying to do it right at the peak or right at the top, and then, there's a higher probability of it going back down. So the buy right strategy on red days, you can increase your chance of profit, and there's a more favorable risk reward because you're buying hopefully at a low, sort of down there at support levels, and then there's a high probability of it increasing. So the risk is not as great and the reward is pretty favorable. Now, if you do this strategy on a green day or a green move, you're going to have better premiums at higher strike prices. So that is one advantage, or there's going to be very good premiums at the money or in the money. So you can use this strategy with in the money call writing, and I have a video on that and how profitable it is to write in the money calls. The third step is just knowing when to exit. And again, this is going to be personal preference, but this is what I do. I exit when most of my profit is made. And for me, that's about 90% for the buy right strategy, because what I'm trying to do is I want those calls to be assigned. I want the call option to be assigned. I want my shares to be called away. That's why I'm performing this strategy. If not, that's okay. I'll just repeat it for the following week or the following expiration. But ideally, I want those options to be assigned. So I'm going to let it and give it the greatest chance of it being assigned by holding out until I know that it's probably not going to be assigned. That's usually about 90% of the max profit. Now, once I exit, then you can simply write another covered call or sell another covered call for the following expiration. If the option is close to the money, then what I do is I either let it expire, and hopefully it expires in the money, my shares get called away, and then I can repeat the process, or it's going to expire worthless. I keep the full premium, and then I wait until the following Monday to open up another position. So, I really look right on expiration day if I haven't reached 90% yet, but I look at expiration day, and then I just monitor that option closely to see if I'm going to just let it ride out until expiration, or if I can set up another trade for the following expiration. So why do I use this strategy? What are its advantages? Well, I can sometimes enter a trade with less capital, especially with my broker, Robinhood, when I'm using margin. For example, if a stock costs $10, and I want to write a cash secured put, that is the first part of the wheel, then I need $1,000 in order to put that trade on, because I need to be able to have the money to buy 100 shares at $10 a piece. So I need $1,000 in cash. If I want to use the buy right strategy and I'm using margin, I could potentially buy those shares for only $500 of my cash, $500 of the broker's margin, then I can sell a covered call on it. So therefore, I can use this strategy when I don't have enough of my own capital to enter a cash secured put. So that's one advantage that I see using it. Sometimes different brokers have different margin requirements, and there's not really this advantage. But for me, that's an advantage. I can also enter a position without waiting for a cash secured put to be assigned. So sometimes people really want a stock and they sell a cash secured put on it, but you have to wait until it expires in the money in order to take possession of that stock. But if you really want that stock and it's at an attractive price, then you can just go ahead and purchase a stock and then run this buy right strategy. So when you do that, you can take advantage of these low stock prices, especially when a stock is falling, and in a market environment like we're experiencing now with just many red days, red weeks, and red months, then, it may be a good time to purchase stocks. And when you do, now you can take advantage of the of this buy right strategy. And when you buy stocks at a lower price, as you know, it can be more profitable because of the stock appreciation. So if you buy stock and write a covered call, an out of the money covered call on it, then you gain the profit from the premium from the short call, as well as the stock appreciation that may occur if that call expires in the money. So it could be more profitable than cash secured puts in some cases. So those are the advantages that I see using this strategy. I still use both of them, but in some cases using the buy right strategy, or the second half of the wheel, is just a little bit more attractive to me. So here are the two great resources, or the two screeners that I mentioned earlier, the weekly options, or weeklyoptionslist.com and optionsellerroi.com. Both of these links will be down in the description. So over the past 5 weeks, I've tracked several stocks that have been chosen by using these screeners, and I've tracked their performance on if they would have been assigned or not, specifically for the buy right strategy. So if you want to check those out, these are what the thumbnails look like. Weeklyoptionslist.com are all the purple background, and Option Seller ROI, that's all the teal or turquoise background. So if you want to check those out and how they perform, then I encourage you to do so. Both of them I recommend highly, and I give some advantages and disadvantages of each one in different videos. But overall, if you are looking to enter a trade, let's say the week before, then weeklyoptionslist.com is probably what you're looking for, and that is a membership. There is a service fee for that. But if you're not on a particular weekly schedule, or you want to sell monthlies using this strategy, then I would recommend optionsellerroi.com, because there's no weekly expiration limitation that you have. Plus, it's a free service. So they're two different websites, two different developers, but I give reviews on both of these services, and I'm differentiating them based on the thumbnail color. So if you have any questions about this strategy or about selling options in general, then go ahead and leave a comment down below, or you can ask me on Twitter at Trading5Talents. And if you want to keep up to date with my progress on using the wheel strategy and lifestyle trading, and how I'm using the option selling strategies of cash secured puts and covered calls to pay some monthly bills, then go ahead and click on the subscribe button and turn on the notifications so you can catch all of the updates. Until next time, trade wisely and take care.